The woman behind the counter is not deciding anything. She is not judging you. She could not stop what happens next if she wanted to. She is typing what you say into a box on a screen, and something on the other side of that box is reading every word. That something does not know you. It does not know you are honest. It does not know you have banked there for 30 years. It knows patterns, and it is listening for 3 very specific kinds of sentence. Say one of them, and a hold can land on your account before you get back to your car. Now, I want to be clear about what this video is because there is a lot of nonsense on this subject, and you deserve better. I am not going to tell you the government is coming for your savings. I am not going to tell you to hide money. Everything I am about to describe is legal, published, and in most cases genuinely well-intentioned. What I am going to tell you is that the system listens for language, not intent, not character, language. And a completely innocent person who uses the wrong words gets the same result as a guilty one who uses them. So this is a video about how to speak to your bank. That is all it is. 3 sentences to never say, why each one trips a wire, and the exact words to use instead. And I will finish with something almost nobody knows about, which is the single form you can fill in that stops most of this from ever happening to you. It takes 4 minutes. It is free, and it is sitting at every bank in this country, unmentioned. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the second sentence in this video changed in a very specific way this year, and the hold it can produce is now measured in weeks rather than days. Let me start with the principle underneath all 3, because if you understand this, the rest becomes obvious. Your bank is not a private business holding your money, not in any legal sense that matters here. It is a regulated entry point into a federal monitoring system, and it has been since 1970. That means the person serving you has obligations that have nothing to do with customer service. When a transaction is unusual, they are required to ask about it. When you answer, that answer goes into a field, not a memory, not a friendly note, a record. And the compliance system on the other side of that record is not weighing your character. It is checking whether your words match certain patterns. If they do, it escalates. Automatically, without anybody at that branch making a decision about you at all. So being a good customer does not protect you. 20 years of history does not protect you. Knowing the manager by name does not protect you. None of that overrides the pattern matching, because the pattern matching is not theirs to override, which means the correct way to speak to your bank in 2026 is the way you would speak to any official body. Polite, brief, accurate, and fully aware that every word is being written down. Now, the first sentence. Never say anything that sounds like you are managing the size or timing of a transaction to stay under a reporting threshold. Here is what that actually sounds like in real life. Can you split this into 2 deposits? I will take out $9,000 today and come back tomorrow. I want to keep it under the limit. My son-in-law told me to keep deposits under $10,000. Every one of those, in the eyes of federal law, is an admission of intent. The offense is called structuring, and here's the part that genuinely shocks people, so let me say it plainly. Structuring is a crime even when the money is completely clean. You can be a retired teacher with 40 years of spotless tax returns. You can have saved that money 1 paycheck at a time. You can owe nothing to anyone. And if you say the wrong sentence at that counter, you have described a federal offense on a system that is recording it. Why does it work that way? Because the law was written to catch people evading the report, separately from whatever they were hiding. The evasion itself is the crime, which made sense when it was aimed at organized crime, and produces genuinely absurd outcomes now that ordinary people have heard about the $10,000 number and try to be helpful by staying under it. So here is what to do instead, and it is simpler than people expect. If your transaction is over $10,000, let it be over $10,000. The report that gets filed is called a currency transaction report, and it is routine paperwork. Millions are filed every year by ordinary people doing ordinary things. It is not an audit, it is not an accusation. It is a receipt. The danger is never the report. The danger is anything that looks like avoiding the report. And if your transaction happens to be under $10,000, then do not mention the number at all. Do not say you kept it under. Do not say you did not want it reported. The number should simply not exist in your conversation. You are depositing the amount you have, nothing more. Let me tell you about Dwight. Dwight is 73, and he sold a boat he had owned since 1994. The buyer paid him $11,400 in cash, which is how boat sales between two old men in a driveway have always worked. On the way to the bank, he decided to be careful. He had heard somewhere that anything over $10,000 gets reported. He did not want the attention. So he deposited $7,000 that morning and told the teller he would bring the rest in on Friday. The teller asked why he was splitting it, and Dwight, being an honest man, told her the truth. He said he did not want it reported. That sentence is the entire problem. Not the money. The money was completely legitimate. The sentence. He was not arrested. Nothing dramatic happened in the lobby. But a report was filed and a note went on his account, and the next time he did anything unusual, the system was already watching him. Dwight was trying to be careful. That instinct, the quiet, cautious instinct of a generation raised to keep their business to themselves, is precisely what this law punishes. That is the whole reason the quiet rules exists. Plain English, printed large enough to read without hunting for your glasses, on the things that quietly decide what happens to your money. What the reporting thresholds actually mean, which words trip a wire, and the exact sentences to use instead, so that a careful person is never punished for being careful in the wrong direction. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always. If it does not hand you something you did not have before, you send it back. So here is a question worth sitting with. Have you ever tried to be helpful to your bank by explaining more than they asked for? Now, the second sentence. And this is the one that changed most in 2026. Never say anything that pattern matches to a scam script. Here is what happened, and you need the background to understand why this is different now. Congress and the states have spent several years building protections against elder financial exploitation, and the losses justify it. Seniors in this country lost roughly $7.7 billion to fraud last year. Financial institutions filed over 155,000 reports tied to elder exploitation in a single 12-month period, covering around $27 billion in suspicious activity. So the response was to give banks legal cover. More than 30 states now have what are called safe harbor laws. They protect a bank from being sued when it delays or freezes a transaction because it suspects a senior is being exploited, provided it acts in good faith. Now think about what that incentive actually does. The bank cannot be sued for freezing too much. It can absolutely be punished by regulators for freezing too little. So it freezes. And the windows have grown. North Carolina passed legislation this July allowing institutions to hold a transaction for up to 30 business days when they reasonably suspect exploitation of an older or disabled customer. Maryland has approved comparable authority. More than half the states now allow some version of a delay. 30 business days is 6 weeks, on a transaction you initiated with your own money from your own account. There is also a technical layer underneath it that nobody talks about. Behavioral monitoring is now standard across financial institutions. The systems build a picture of what is normal for you and flag what is not. If you have never wired more than a few $100s and you suddenly attempt to wire $10,000, that alone can halt the transaction pending human review, regardless of what you say. And there is a specific mechanism inside the transfer network worth knowing by name, because it explains why some transactions stop dead with no warning at all. When a transfer does not match your historical pattern, the network has a return code for it. The transaction is marked questionable and sent back for manual review before it ever leaves your account. That is not a person deciding you look suspicious. That is arithmetic comparing this transaction against every previous transaction you have made and finding a shape it does not recognize. Which means your own history is now part of the equation. Somebody who moves money regularly has a wide normal, and a large transfer barely registers. Somebody who has done the same 3 things every month for 15 years has a very narrow normal, and any departure from it stands out enormously. And that is genuinely backwards for this audience. The most careful, most consistent, most predictable people, the ones who have never done anything irregular in their financial lives, are exactly the people whose one unusual transaction looks most alarming to a system built on pattern deviation. Let me also tell you what a hold actually looks like from your side, because people imagine something dramatic and the reality is quieter and in some ways worse. Usually nothing is announced. You do not get a call explaining that your money is under review. You attempt the transaction and it does not complete. Or it appears to complete and then reverses a day later. Or your card is simply declined at a counter somewhere with money plainly sitting in the account. Then you telephone, and you reach somebody in a general service queue who can see that something is flagged, but cannot tell you why, because the details sit with a compliance department that does not take customer calls. And in most cases, nobody at that bank is permitted to tell you a report was filed. That is not rudeness or evasion. Federal law prohibits disclosing that a suspicious activity report exists. So the person you are speaking to may know exactly what happened and be legally barred from saying it out loud, which is why prevention matters so much more here than argument does. Once the process starts, there is very little you can say to speed it up, and the people you can actually reach are not the people who decide. So what are the sentences? My grandson called and he is in trouble and needs money today. I met someone online and he is overseas and needs help getting here. My friend told me about an investment with guaranteed returns. The Microsoft people are helping me move my money somewhere safer. A man from the tax office called and said I can pay with gift cards. Every one of those is a near certain hold in 2026. And here is the part that matters most for you, because most of you are not being scammed at all. This same protocol catches people doing perfectly legitimate things that happen to look like the pattern. You sell a car to a stranger from an online listing and mention the word online. You genuinely want to buy Bitcoin through a regulated exchange and mention crypto. Your grandson is actually in trouble, genuinely, and you say so. In every one of those cases, you have done nothing wrong and broken no law. But the protocol is not weighing your rights against the rule. It is weighing the bank's exposure against your inconvenience. And the bank's exposure is far lower if your money is delayed and you are annoyed than if it moves and turns out to be a scam. So the instruction is this: do not volunteer language that matches the script, even when you are not being scammed. Avoid online, avoid crypto, avoid overseas, avoid urgent, avoid gift cards, avoid in trouble, avoid guaranteed. Explain your transaction in the most boring language available. This is a gift to a family member. This is a personal investment. This is payment for a private purchase. True, brief, calm. No story, no keywords. Let me tell you about Marlys. Marlys is 68 and her son needed $5,000 quickly for something entirely legitimate. A legal deposit. Real, documented, urgent for ordinary reasons. She went in to wire it. The teller asked what it was for, and Marlys, wanting to be helpful, explained the whole thing. She said her son was in trouble and needed the money that day. Those two phrases together, in trouble and that day, are almost word for word the opening line of the grandparent scam. The system does not know her son. It knows the shape of that sentence. The wire was held. She spent an hour on the phone with a fraud department explaining that her own son was not a criminal. The money eventually moved. Her account carried a flag for 2 months afterward. Nobody treated her badly. Everybody involved was doing their job correctly. She simply told the truth in the exact words the machine was built to catch. That is exactly the gap this guide closes. Not to teach anybody to be evasive, to give a person the plain, honest, boring sentence that satisfies the requirement, so that telling the truth does not accidentally sound like a confession. Same place, kevinexplains.shop, link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. Now, the third sentence, and this one has been hiding in plain sight for over 40 years. The third trigger is not about saying too much, it is about saying too little. Never refuse to answer. Here are the sentences. That is none of your business. I do not have to tell you. You have no right to ask me that. It is my money. Just process the transaction. Every one of those is a red flag under federal compliance standards. Now, you are right. It is your money. You are legally allowed to refuse to answer. Let me be completely clear about that because I am not telling you that you have no rights. But here is the trap, and it is genuinely uncomfortable. The bank is also allowed, and in some circumstances required, to file a report when you refuse. Under anti-money laundering rules, institutions are obligated to know their customers and to be able to explain unusual activity in your file. If they cannot explain it, they are exposed. If you decline to give them what they need to explain it, escalation is their only protection. So asserting your right triggers the report, and the report can trigger the hold. This one hits retirees harder than anybody else, and I understand exactly why. There was an America where your bank was your bank, the manager was your neighbor, and your money was nobody's business. Many of you remember it clearly. That America still exists in feeling. It stopped existing in regulation decades ago, in stages, and nobody sent a letter about it. And I want to acknowledge something honestly here, because I think a lot of you are feeling it right now while you listen to me. There is something genuinely humiliating about being questioned over your own money. Not inconvenient, humiliating. You worked for 40 years, you saved it, you paid tax on it, and now a person young enough to be your grandchild is asking you to justify what you intend to do with it. And the honest answer, that it is yours and that should be the end of the discussion, is the one answer that will cause you trouble. I am not going to pretend that is fine. It is not fine. It is the price of a system that was built to catch criminals and now processes everybody through the same filter. What I will say is this: the person asking is not doing it to you. They are reading from a script written by a compliance department that will discipline them for skipping it. Whatever you feel about the question, the person in front of you is the wrong target for it, and treating them as the enemy converts a routine interaction into a flagged one in about 10 seconds. So the discipline required here is emotional rather than legal. You are not conceding that they have a right to your business. You are recognizing that a short, boring answer ends the conversation, and that indignation, however justified, extends it. So what do you actually do? You do not surrender your privacy. You exercise it efficiently. When you are asked what a withdrawal is for, the correct answer is not silence. It is also not a 5-minute story about your life, because a long story drops keywords into the system. The correct answer is one sentence, 8 to 12 words, boring and true. Personal expenses, home repair, a family gift, a private purchase, medical costs, a vehicle purchase. That is it. You have answered. The teller has something to put in the field. The compliance system has a category. The transaction proceeds. You did not lie, you did not refuse, and you gave away nothing beyond what was asked. Now, the thing I promised you at the start, and it is the single most useful item in this video, there is a form at your bank called a trusted contact designation. It lets you name one person the bank is permitted to telephone if it suspects something is wrong, or simply needs somebody to vouch for an unusual transaction. Your daughter, your son, a friend you trust completely. Here is what it actually does for you. It gives the bank a release valve. Instead of the only options being process it or freeze it, there is now a third option. Ring the daughter and ask whether mom really is buying a car. And here is what it does not do, because people get frightened of this. Naming somebody does not give them access to your account. They cannot see your balance, they cannot move your money, they cannot make decisions for you. They are a phone number, nothing more. 4 minutes at a branch, or through your online banking, free. Available at essentially every institution in this country, and almost nobody fills it in because almost nobody is offered it. Choose that person carefully and tell them you have done it. That second part matters more than people realize. A trusted contact who receives an unexpected call from a bank and has no idea why they are being asked about your finances may say something cautious or confused that makes the situation worse rather than better. Somebody who knows in advance that they are your named contact answers with confidence, and that confidence is often the entire difference between a transaction resuming and a transaction sitting for another week. And choose somebody who is not a beneficiary of the transaction. If you are wiring money to your son is the worst possible person for the bank to call to verify that the wire is legitimate. Name somebody with nothing to gain. There is one more piece of preparation worth doing, and it costs you nothing but an afternoon. Introduce yourself to your bank before you need anything from it. That sounds quaint, and it is genuinely practical. Walk in on an ordinary day. Ask to speak to the branch manager for 2 minutes. Tell them who you are, roughly what your accounts are for, and that you occasionally make larger transactions for family or home repairs. You are not asking permission. You are building context. Because when a flag lands, somebody reviews it, and a review that begins with a manager who can say, "I know this customer. She came in and introduced herself. This is consistent with what she told me," ends very differently from one that begins with a name nobody recognizes. That is not a loophole either. It is exactly what the Know Your Customer requirement was originally designed to mean before it became a software problem. 2 more things in the same category, and then I will give you the list. If you know a large transaction is coming, telephone the bank in advance. The sale of a property, an inheritance arriving, a settlement, a scheduled transaction with a documented source announced beforehand almost never gets frozen. It is the unexpected and unexplained that trips the system. Remove the surprise and you remove the trigger. And if a freeze does happen, do not telephone and shout. Go in person with identification and bring documentation of where the money came from. A bill of sale, an estate document, a contractor's invoice. Paperwork resolves holds faster than argument ever will. Now let me give you my honest opinion, which is only that. I do not think these laws are wrong. That is not where I land on this, and I want to be straight with you rather than selling outrage. $7.7 billion taken from older Americans in a single year is a genuine catastrophe. The safe harbor laws exist because banks used to watch a scam happen and process the transaction anyway, because stopping it exposed them to being sued. Removing that fear was reasonable. Some of you are alive with your savings intact because a teller stopped something. My objection is narrower, and it is about balance. When you protect an institution completely from the cost of freezing too much and leave it fully exposed to the cost of freezing too little, you have not created a judgment. You have created a direction. Everything tips one way. And the person absorbing the cost of that tilt is a 73-year-old woman who cannot pay her contractor for 6 weeks and has done nothing wrong. And underneath that is the thing this channel keeps arriving at. Not one person is ever told any of this. There is no notice explaining that the words you choose matter more than the facts. Nobody mentions the trusted contact form. The rules are published, they are correct, and they are written for compliance officers rather than for the person standing at the counter. And there is one more piece of this that genuinely bothers me, so I will say it and then move on. The threshold that started all of it, the $10,000 figure, was set in 1970. It has never been adjusted. Not once, not for inflation, not for anything. $10,000 in 1970 was a substantial sum of money. It was a meaningful fraction of a house. Today, it is a roof repair, a used car, a single month in an assisted living facility, a hospital bill after insurance. So a number that was designed to identify genuinely unusual activity now describes an ordinary Tuesday for a great many households, and the entire reporting and freezing apparatus is still calibrated to it. That is not anybody's fault in particular. It is what happens when a rule is written and then simply left there while the world moves around it for 56 years. But the effect is that a system built for criminal networks now processes retirees making completely ordinary transactions and treats the two identically. All right, here is your list. 5 things. 1. Never reference the $10,000 threshold in any way. Do not split, do not time, do not mention it. If a transaction is over it, let it be over it. 2. Never use scam script language. No online, crypto, overseas, urgent, gift cards, in trouble, or guaranteed. Use the most boring, true description available. 3. Never refuse to answer. 1 sentence, 8 to 12 words, plain and true. Personal expenses, home repair, family gift. 4. Fill in a trusted contact designation at every institution you bank with. It takes 4 minutes, it costs nothing, and it gives the bank somewhere to turn other than a freeze. 5. Telephone ahead of any large transaction you know is coming, and keep the documentation. A scheduled, explained transaction almost never gets held. And if your own situation is tangled, if your account has been frozen and you cannot work out why, write to me. The address is on your screen and in the description below, and I read every one that comes in. One last thing before you go. Dwight told the exact truth about a boat he sold in a driveway, and the truth was the thing that flagged him. And Marlys told the exact truth about her son, in the wrong words, and spent an hour proving her own child was not a criminal. Neither of them did anything a reasonable person would not have done. Neither of them broke a single rule. Both of them were honest, and honesty in the wrong wording produced the same result as dishonesty would have. So this week, do one small thing. Write down 3 sentences on a piece of paper and put it in your wallet. 1 for a large deposit, 1 for a large withdrawal, 1 for a transfer. 8 to 12 words each, boring and true. The day you need it, you will be very glad you wrote it before you needed it. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.